Okay, let's unpack this.
Right?
We have a massive amount of information in front of us today. Really the definitive blueprint for, well, for Apple.
Mm-hmm. And crucially, this isn't, the marketing spin.
No, this is the document the company legally certifies as fact.
Freshly delivered, their official regulatory filing.
That's the key thing, isn't it?
It is. Our mission today is a real deep dive into that official SEC filing, the Form 10-K.
Covering Apple's fiscal year ending September 27, 2025.
Yeah, this 10-K, it's the operational reality. It lays out everything.
From product strategy, financials,
to the really complex and honestly escalating strategic and legal risks they're facing.
especially around regulation, right? That seems to be heating up.
Oh, definitely, particularly targeting their most profitable business segment. We'll get into that.
And just the scale we're talking about here, it's hard to grasp.
It really is. To set the baseline, the document confirms it. Back in March 2025, the market value of the non-affiliate stock
Was about $3.253 trillion.
trillion. It's just a staggering number.
And it really sets the stage, doesn't it? This is a global economic force we're looking at.
Absolutely. Every action, every risk, it's all under this intense microscope now.
When your market cap is north of $3 trillion, well, everything matters more.
Every single percentage point of growth,
Yeah.
every tariff cost, every legal decision, it all has potentially historic significance.
And because we're sticking purely to this audited filing.
We're essentially analyzing management's own assessment, their view of the vulnerabilities, the opportunities for the year ahead.
Okay, so let's start with that core identity, the products.
Right. Most people, they get the ecosystem.
iPhone, Mac, iPad.
Yeah. But the 10K formalizes how they see it, those 5 critical categories.
Smartphone, so iPhone, personal computers, Mac, tablets, iPad.
Then wearables and accessories. And the big one for the future, services.
That services piece just keeps growing in importance.
It does. And what jumps out immediately from the filing is just the relentless pace of innovation required.
You mean just to keep up?
To keep up, to maintain market share against, frankly, fierce competition. It demands this constant high-velocity product flow.
And the 10K documents that for FY 2025, it was a busy year.
A dizzying schedule, really.
And not just small updates, right? They kicked off the fiscal year strong. Q1 2025.
Yeah, major refreshes in computing. New MacBook Pros, Mac Mini, iMac, and an updated iPad Mini.
Then Q2 brought even more.
A broader mix. The mid-cycle iPhone 16, updated iPad Air, the standard iPad.
A new MacBook Air and the high-end Mac Studio.
Exactly. But if you look at the timing, the strategy,
It's all about Q4, isn't it?
that's the concentration. The Q4 launch window is the revenue rocket fuel. It feeds that critical holiday quarter.
And that's when they rolled out the big guns for 2025.
The full flagship line, yeah. iPhone 17, the Air model, the Pro Max.
And wearables too. New watches.
Concurrently, yeah.
Yeah.
Apple Watch Series 11, the SE3, the Ultra 3, plus the new AirPods Pro 3.
But that heavy Q4 concentration, it highlights a pretty significant risk, doesn't it?
Oh, absolutely.
Relying so much on just a few weeks of flagship launches.
To define a whole quarter, sometimes a whole year, it demands near-perfect execution.
On design, manufacturing, logistics, everything has to line up.
It absolutely does. The entire global supply chain is basically geared towards that one specific high-pressure window.
So if anything goes wrong,
Failure to execute, yeah. Or even just like modest consumer disappointment in a flagship cycle, that can have really outsized negative consequences.
and they also specifically mention the Vision Pro in wearables.
Right, they categorize it under wearables, home, and accessories, calling it the spatial computer running Vision OS.
Which shows they're still investing heavily in that next platform, right? Trying not to be just the iPhone company forever.
Exactly. It's active investment in, platform risk mitigation, diversifying beyond just the iPhone.
Okay, so moving from products to the global map, how do they manage this huge operation?
Geographically, they recognize that markets are different around the world.
Pricing, regulation, competition, it all varies.
Precisely. So they have 5 reportable segments.
Let's quickly outline those.
Okay. Americas, that's North and South America. Then Europe.
And Europe is a big grouping, isn't it? Includes India, Middle East, Africa.
It is. Strategically very interesting. It bundles mature markets with huge emerging ones, like India,
Then Greater China,
mainland China, Hong Kong, Taiwan, critically important.
Japan, and finally,
Rest of Asia Pacific, so Australia, Korea, Southeast Asia, etc.
and that structure is key for us to understand, where the growth is actually coming from.
And where the challenges are, like we'll see with China later.
Well, how do they actually reach the customers distribution channels?
It's a split, a hybrid strategy.
Okay.
Direct channels, that's their own retail stores, their online stores. The direct sales force that accounted for 40% of net sales in 2025.
40% gives them huge brand control, that premium feel.
Exactly. They control the experience.
But that means 60%, the majority, is indirect.
Right, through third parties.
So, does relying on carriers and resellers for 60% of sales, does that weaken their control over things like pricing or promotions?
It's a constant balancing act, a really careful one.
The carriers must have a lot of leverage.
They do. That 60% mainly flows through cellular carriers and other resellers. Apple sets the base price, sure, but the carriers...
Because of their sheer volume and control over subscribers?
Yeah, they often influence the promotional strategy, the volume commitments.
So there's risk there too.
Definitely. If a major global carrier suddenly decides to prioritize a competitor or, say, changes its subsidy strategy dramatically, that could hurt Apple quite a bit.
Okay, let's pivot to the numbers. The financial report card for fiscal 2025.
Right. The headline numbers look pretty strong. Suggests a successful year overall despite global economic headwinds.
So, top-line revenue.
Grew a respectable 6%, up to $416.161 billion. That's from $391 billion in 2024.
Okay, 6% growth, but profitability.
That jump was more notable. Net income hit $112.010 billion in 2025.
Wow, $112 billion, up significantly from
$93.7 billion the year before. So, a very profitable year.
a staggering profit, really. But when you break it down by those geographic segments we just discussed,
Yeah, the picture isn't quite uniform success.
so the headline numbers look good, but underneath, are there some cracks maybe appearing?
I'd say the latter, definitely. The segments showed pretty significant volatility. It really underscores why they manage it geographically.
So where was the strength?
The Americas,
Yeah.
still the undisputed heavyweight champ, $178.353 billion in revenue,
Growing.
a healthy 7%. And the 10K says that's primarily driven by iPhone, especially those higher-priced Pro models, and crucially, services growth.
Okay. And Europe?
Also performed well. Expanded 10% to hit $111 billion.
Also fueled by services and iPhone?
Services, iPhone, and actually Mac sales, too, were strong in Europe.
Interesting. Japan?
Japan had the strongest percentage increase, soared 15%.
15 to $28.7 billion. What drove that?
Seems to be a strong consumer affinity there for iPhone services and iPad,
And rest of Asia Pacific?
also up 10%. So strong growth across most regions, except...
Except Greater China,
Exactly. The primary drag on overall growth came from Greater China.
which is strategically critical, both as a market and for manufacturing.
Hugely critical. And net sales there decreased by 4%, settled at $64 billion.
A decrease. Why?
The 10K is explicit, primarily due to lower iPhone sales.
Ouch. Partially offset by Mac, maybe?
Partially offset by stronger Mac performance, yes, but not nearly enough.
So in that really intense competitive environment in China,
That 4% dip is a significant warning signal. It suggests rivals are gaining traction or maybe consumers are shifting priorities. It's something to watch closely.
okay, let's shift from geography to the product categories themselves. iPhone is still the foundation, right?
Absolutely. The empire's built on iPhone. Sales increased 4% to $209.5 billion.
4% growth seems okay, but maybe not spectacular.
Maybe not spectacular in percentage terms, but the detail buried in the 10K explains the profitability story behind that number.
Oh, okay, what's a detail?
The growth was specifically attributed to higher net sales of Pro models.
The more expensive ones.
Exactly. It's a powerful signal of pricing strength. Unit volume might not be exploding, but the average selling price, the ASP...
Flying up because people are choosing the highest spec, highest margin phones.
Precisely. It gives them a buffer against slowing unit growth. Very important strategically.
Beyond iPhone, what else stood out? Mac seemed strong.
Mac was actually a surprising success story, yeah. Strong 12% increase, $33.7 billion.
Driven by laptops and desktops.
Both, according to the filing.
And iPad.
More modest growth there, up 5% to $28 billion.
How did they manage that?
It seems they compensated for lower sales of the high-end iPad Pro.
With higher sales of the Air, the Mini, and the standard iPad models. So a mix shift downwards, maybe?
Potentially, or just broader appeal in those mid-range models.
Okay. And then the last category, wearables, home, and accessories.
And this is where we actually see contraction.
A decline in that huge category.
Yeah, net sales declined 4% to $35.6 billion.
Why? What does the filing say?
Attributes it to lower net sales in accessories and wearables generally. So watches, headphones, accessories.
Does this suggest maybe the Vision Pro launch? I know it's early days, but did it fail to lift the boat for the rest of the wearables business?
It's likely too early for Vision Pro to have a material impact on these specific numbers. That's more an investment for future years, right?
Right. Limited volume probably in FY25.
Exactly. But the decline in the overall category, I think it highlights saturation
Hmm.
and fierce competition, especially from lower price competitors for things like watches and earbuds.
So even Apple Watch and AirPods aren't immune to market pressure.
It emphasizes that, yeah.
Hmm.
Even their highly profitable ancillary products face challenges.
Okay, so if products are the muscle, services is the brain and the profit engine.
That's a good way to put it. This is where the story really shifts from selling hardware,
To selling recurring access and experience.
and services hasn't just cemented its role as a growth driver, it's become a critical stabilizer for the whole company's profitability.
How big was the growth in services?
Robust 14% growth, hit $109.158 billion in net sales.
Over $100 billion. It's a massive business on its own.
Absolutely. Contributing over a quarter of total revenue now.
And what's driving that 14% jump? Is it broad-based?
The filing gives clarity there. Primarily higher net sales from advertising,
Okay.
the App Store, and cloud services.
So the whole subscription suite, basically.
Pretty much Apple Arcade, Fitness plus Millis, Music, News plus Millis, TV plus Millis, AppleCare, payment services. It all rolls up into this.
Every download, every subscription, every iCloud storage payment.
Fuels this segment's growth.
Yeah. Okay, but here's where it gets really, really interesting, right? The margin.
That's the key. The massive disparity in margin power between the two core businesses.
Aha moment in the 10K.
It really is. You have to compare the gross margin percentages.
Let's hear them. Products first.
Okay, products gross margin percentage in 2025 was 36.8%,
36.8, down slightly from the year before.
down just a tick from 37.2% in 2024. Pretty stable, but, in that range.
Okay. Now, services.
Services gross margin percentage was 75.4%,
75.4%.
up from 73.9% the prior year.
Wow. That's more than double the profitability of the hardware business.
More than double. Just speaks volumes, doesn't it?
Yeah.
About the incremental cost of delivering a digital service versus making and shipping a physical device.
Absolutely. So while the hardware business generated a huge amount of gross margin dollars,
About $112.8 billion in product gross margin, yeah.
it's vulnerable to manufacturing costs, commodity prices.
And tariffs. The 10K specifically noted that the product gross margin percentage was held back, partially offset by increasing tariff costs.
So tariffs are directly hitting that product margin.
Yep, explicitly called out.
So you've got tough competition and geopolitical tariffs effectively capping product profitability in the high 30s.
That seems to be the reality. Meanwhile, on the services side,
Protected by its distribution model, recurring revenue.
generates cash flow at a 75% margin. It makes that high margin revenue not just nice to have, but structurally essential for meaningful profit growth.
Which explains why they push so hard on services.
Every strategic move, more advertising, new subscription bundles,
Mm.
it's all geared towards expanding that services footprint.
Because the cost to serve each new subscriber is minimal.
Tiny. So almost all the new revenue drops straight to the bottom line. It's vital insulation against those supply chain risks, too.
Okay, but now we pivot to the risk factor section, and here's the irony, isn't it?
It is quite ironic.
The very success of that 75% margin services business is what's drawing the most intense regulatory fire.
Exactly. While the product business fights those traditional battles. Let's start there, though, with competition on the hardware side.
What does the 10K say about their competitive position?
It's remarkably candid, actually. Describes markets with hyper-aggressive price competition, really short product cycles, constant tech churn.
And the key point.
The crucial strategic fact, Apple holds a minority market share globally.
In smartphones, PCs, tablets, wearables, they're not the volume leader.
Correct. Which means they are constantly having to justify a massive premium price point.
Against rivals who copy features.
Continuously imitate features, yeah.
Yeah.
Aggressively cut prices.
Some competitors even sell at a loss.
Some operate with cost structures, allowing them to offer products at little or no profit, or even a loss, just to grab market share.
That structural pressure explains why even 36.8% product margins are hard to maintain.
It really does, and reinforces why that 75% services buffer is so critical.
Okay, moving to operational stability. The supply chain risks. Where is the manufacturing power concentrated?
Still primarily with outsourcing partners in China, mainland India, Japan, South Korea, Taiwan, and Vietnam.
They've been trying to diversify, moving more into India and Vietnam.
They have, and that's noted. But the concentration, especially final assembly in China mainland, still creates a significant vulnerability.
To industrial disruption or worse, geopolitical tensions.
Absolutely. And it's not just assembly, it's the components themselves.
Right, the custom chips, the unique parts.
The filing explicitly warns many essential, high-value custom components come from single or limited sources.
A single factory fire, a natural disaster, a trade restriction.
Could be catastrophic, severely limiting production, potentially causing rapid price hikes. They are constantly managing these supply shortage risks.
And the 10K even gives a specific current example of geopolitical risk hitting costs, right? The tariffs.
Yes, the update from Q2 2025. New U.S. tariffs were imposed.
On imports from where?
Major supply chain and revenue regions: China, India, Japan, South Korea, Taiwan, Vietnam, even the EU.
So this isn't theoretical anymore.
No, management states it directly increases costs, limits availability of products and components, and they explicitly say these tariffs impact pricing power and the product gross margin.
We saw that slight dip in the margin percentage. That's a direct hit.
Seems directly linked, yeah.
Okay, finally under risks. Human capital and R&D. The innovation engine.
Crucial. In this landscape where competitors copy everything,
The only defense is to innovate faster.
right. And the commitment here is just staggering. Headcount first. About 166,000 full-time equivalent employees as of September 2025.
166,000 people. And the R&D spend.
Increased a substantial 10% year over year. Total R&D expense in fiscal 2025 was $34.55 zillion.
$34.5 billion on R&D in 1 year.
It's more than the GDP of some countries.
What's that massive increased funding? What can we infer?
The filing says it's primarily headcount-related expenses, infrastructure, and developing new tech. We can infer it's fueling their big push into AI.
Generative AI features across the board.
Seems likely. Further refinement of Vision OS, the Vision Pro hardware itself. Long-term bets on their own custom silicon.
It's the necessary cost of staying ahead.
It's the $34.5 billion shield. Without it, their ability to introduce truly innovative products, the justification for the premium price would just erode. The whole model depends on it.
Which brings us squarely to the legal and regulatory storm clouds.
The most dynamic risk in the whole filing, I'd argue.
And it's specifically targeting the profitability of that golden goose, the 75% margin services segment.
Exactly. They're facing unprecedented, coordinated global challenges to that walled garden distribution model.
Let's start with Europe. The Digital Markets Act, the DMA.
The DMA has delivered the most immediate and, frankly, costly blow so far. The 10K lays out a rapid enforcement timeline.
Okay, walk us through it. Investigation opened March 2024.
On Article 5.4, yes. Then a major consequence landed on April 23, 2025.
The fine.
A fine of $500 million, which is substantial, but maybe not the biggest hit.
What was the bigger hit?
The cease and desist order. It immediately required Apple to remove technical and commercial restrictions.
The ones preventing developers from steering users outside the App Store.
Precisely, preventing them from pointing users to alternative payment or distribution channels. Apple's appealing, but they had to start complying right away.
And the DMA threat isn't over, is it? There's another investigation.
Correct. Under Article 6.4, regarding new contractual terms they tried to implement. That's a significant hanging threat.
Why? What's the potential penalty there?
Preliminary findings are out. If a violation is confirmed, the fines can be up to 10% of annual worldwide net sales.
10% of $416 billion.
Over $41 billion. Suddenly, regulatory risk isn't just a cost of doing business. It's an existential threat to profitability.
And the pressure isn't just Europe. The U.S. is hitting them hard, too.
Simultaneously, yeah. Major antitrust actions.
The DOJ lawsuit first, filed March 2024.
Alleging monopolization in performance smartphones and smartphones generally, that's ongoing. Apple's defending vigorously.
But the Epic Games case, that seems to have taken a really serious turn based on this filing.
It has. This is maybe the most severe piece of legal news in the 10K.
What did the court find?
On April 30, 2025, the U.S. District Court found Apple to be in violation of the prior 2021 injunction.
The one related to developer steering, anti-steering rules.
Exactly. Finding they violated a court order is a serious legal setback. It implies they intentionally failed to comply.
And the court didn't just stop there, did it? There was a referral.
It also referred the company to the U.S. attorney for possible criminal contempt proceedings.
Okay, explain that. For a listener, what does criminal contempt mean for a company versus just a civil fine?
It's a critical distinction. Civil contempt usually means fines against the company until they comply, purely financial.
Right.
A referral for criminal contempt suggests the court believes the noncompliance was willful, deliberate obstruction.
So it moves beyond just money.
It moves into corporate and potentially individual accountability, possible sanctions, even jail time for officers if found guilty of obstructing the court's order. It escalates things dramatically.
Wow. And what did the new injunction in that case actually order Apple to do?
It's very stringent. Explicitly enjoins Apple from imposing any commission or fee on purchases consumers make outside an app.
So no 15 or 30% cut if the transaction happens externally.
Correct. And it also forbids restricting how developers guide consumers to those external purchases.
That strikes right at the heart of the App Store business model in the US.
Absolutely. It mandates they can't charge if the purchase originates outside and can't stop developers telling users how to do it. They appealed immediately, of course. Oral arguments were in October 2025.
Okay, one more big legal risk area mentioned, licensing revenue.
Yeah, one of their sort of silent revenue giants, the money they get from Google.
For making Google the default search engine on iPhones, iPads.
Exactly. It's a multi-billion-dollar deal.
Yeah.
Huge high-margin revenue stream for the services segment.
And that's under threat because of this separate antitrust case against Google.
Precisely. Following the Google antitrust finding in August 2024, the D.C. court ordered remedies in September 2025.
And how does that threaten Apple's revenue?
The 10K flags the uncertainty. The ultimate risk, depending on how Google's appeal goes, is that a final remedy could legally prohibit Google from offering commercial terms for search distribution.
Meaning Google wouldn't be allowed to pay Apple to be the default search.
Potentially. Which would immediately cut off Apple's ability to monetize all that search traffic through those licensing fees, a direct hit to high-margin services revenue.
So just to recap the legal storm, EU fines and orders, U.S. court finding a violation and referring for criminal contempt, and a major revenue stream threatened by a partner's antitrust case.
All focused squarely on dismantling the structures underpinning that 75% gross margin services business. It's a multi-front war.
Yet, despite all these headwinds, the company's financial foundation remains incredibly strong.
We have to come back to that core fact, yes. Their stability is immense. It gives them the resources to fight these battles.
Let's look at liquidity. How much cash do they have on hand?
As of September 27, 2025, total cash, cash equivalents, and marketable securities, a staggering $132.4 billion.
$132 billion. That buys a lot of lawyers and R&D.
It certainly provides significant operational flexibility and, yes, a legal war chest. Against that, total term debt is about $90.7 billion.
Which sounds like a lot, but compared to the cash.
Relatively manageable. And only about $12.4 billion of that debt principal is due within the next 12 months.
What about immediate spending needs, like securing parts for next year's iPhones?
That's the biggest short-term cash requirement listed. Manufacturing purchase obligations.
So much.
For the next 12 months, a massive $55.4 billion.
$55 billion just committed to suppliers.
It shows how far in advance they have to lock in components and capacity. Demonstrates confidence in future demand, too.
And beyond operations, they're still returning huge amounts of cash to shareholders.
The capital return program is relentless. It's strategic, helps support the stock price amidst all this uncertainty.
What's the latest on share buybacks?
In May 2025, they announced a new authorization, up to $100 billion for stock repurchases.
Another $100 billion on top of the previous one.
It succeeded the prior $110 billion program, which they fully used up in Q4 2025.
How much did they actually repurchase in fiscal 2025?
About $89.3 billion worth of shares, by constantly reducing the share count.
They boost earnings per share even if revenue growth slows down.
Exactly. It's a key mechanism.
And dividends, still going up.
Yep. The quarterly cash dividend was raised again to $1.26 per share, and they state their intent is to increase it annually, board willing.
So, massive buybacks plus a growing dividend keeps shareholders reasonably happy.
It's key to shareholder relations, especially in turbulent times.
Okay, one last financial item to clear up. That huge one-time tax charge from the prior year. The Irish state aid case.
Right, the resolution of that long-running saga. The 2016 European Commission decision on Irish tax opinions.
That was finally settled.
Finalized by the European Court of Justice on September 10, 2024. That confirmation triggered the financial impact.
Which
A
was
substantial one-time income tax charge of $10.2 billion net, recorded back in fiscal 2024.
$10.2 billion, and that was seen as kind of a positive, just for clarity.
Wild, isn't it? But yes, removing that uncertainty was seen as a net positive by investors, even with a huge cost. It really shows the scale of this company.
That they can absorb a $10 billion hit like that.
A hit that would cripple almost any other company. The resolution mainly came through releasing $15.8 billion that was held in escrow.
Which was paid to Ireland, partially offset by some tax credit.
Correct. Cleared the decks on that issue, at least.
Okay, let's try and summarize this deep dive into Apple's 2025 reality.
The story really feels like one of bifurcation, doesn't it?
How so?
Well, overall revenue growth is, slowing down from the explosive rates of the past. And the product business faces these hard ceilings on profitability.
From supply chain concentration, tariffs, intense competition.
Right. Margins are good, but capped. The real lifeline, the engine driving profit leverage, is clearly services.
With that absolutely eye-watering 75.4% gross margin.
That margin is the essential strategic element now. It offsets the slower product growth. It shields the bottom line from rising costs, from geopolitical shocks.
But, and this is the huge but coming out of this 10K,
That very services segment is now the primary target. It's subject to the most severe, globally distributed threats the company faces.
it's no longer just theoretical risk.
Exactly. Fines and mandatory operational changes in Europe, found in civil violation in the U.S., leading to that criminal contempt referral, a key licensing revenue stream directly threatened.
The regulatory environment has hardened significantly.
It's become an actual measurable cost, an operational constraint, and it strikes right at their most valuable IP, the control of their platform.
So what does this all mean for you, the person listening, maybe investing in or just following the economic story of Apple?
I think it means the narrative has fundamentally shifted.
Away from just product innovation battles.
Yeah, it's shifted to focusing much more on regulatory defense and compliance costs. The future value seems to hinge less on, say, the success of the iPhone 18,
And more on rulings coming out of Brussels or California courts.
which raises this really important final question for everyone to grapple with.
Okay, what's the provocative thought to leave us with?
Considering these escalating antitrust actions, the court orders that 500 million DMA sign, the Epic Games violation finding, the Google licensing risk. How much higher does the cost of compliance have to rise?
Before it fundamentally changes the math on that services segment.
Exactly. Before it changes the profitability calculation of that walled garden that currently boasts 75% gross margins.
If fines keep coming, litigation costs mount, platform changes are forced upon them.
That compliance expense could fundamentally reset the service's profit outlook. Regardless of how many new subscribers they sign up next year, that 75% might not be sustainable under this level of pressure.